Okay, with the stock market on the verge of correction, a lot has happened today. So much so that I'm actually going to go off script for this one to get this video out as soon as possible. There's a lot of fear mongering out there already, and I think that in these situations, it's just best to have a more level-headed approach. So hopefully this video can be that for you. What the hell has happened over the last 2 weeks to get us to this point today? Well, it starts with the Fed making the decision to not cut rates in August and instead alluded to a rate cut in September. But a rate cut in September is predicated on the Fed having the data to back them up. Is inflation moderating, and is the job market not too hot and not too cold? But speaking of the job market, the employment situation for July posted 114,000 job additions, which came under expectations. That brought the unemployment rate from 4.1% last month to 4.3%. And although that change isn't huge, it's significant because it triggered what's called the Psalms rule. The Psalms rule is when the unemployment rate exceeds half a percentage point from its 12-month low. And the reason why that's important is the Psalms rule is used as an early indication of recession. I think this week of a report all but guarantees a rate cut in September, and market expectations seem to align with that opinion. But that said, even though a rate cut is expected, many people are actually questioning if the rate cut should have happened this month instead of waiting next month. The fear is that interest rate policy takes a while for those movements to make their way through the system. If the Fed waits until September to make a move, how much further will the job market worsen by the time that policy has an effect? So the questions around interest rates and the job market have culminated into what's going on in the stock market. The stock market today, specifically the S&P 500, is down 3% and 7% over the last month. The VIX, which is an indicator of stock market volatility, is at or close to 38, and anything over 30 is considered high volatility expectations. So the question stands, is it time to panic? I personally lean more towards no, and here's why. In terms of the stock market, is it down significantly? Yeah, meaningfully so. But if you zoom out, instead of looking at the 5-day or 1-month return, and you look at the year to date, the S&P 500 is up almost 10%. That is in line with its historical performance. If the year was to end today, you would say that the S&P 500 had a solid year. Now, in terms of the job market, I'll say this. The historical unemployment rate since 1948 is 5.7%. That is more than a full percentage point above where we are right now. So historically speaking, the job market still has room to contract. I really think this is why the Fed, with the dual mandate of price stability and max employment, has been focused more so on inflation. To them, inflation had a lot of improvement to make versus the job market that still has room to cool off a little bit, for lack of a better term. I also want to make something crystal clear. Just because I say that the job market has room to contract numerically based on historical fact, that does not mean that I am overlooking the significance of a rising unemployment rate. Job loss is a very shitty thing for the individual, for households, for families, for friends, across the board. And that brings me to the last point I want to make about this. My initial reactions are to the national, global data, the macroeconomic indicators. There's a problem with that. When looking at things from a macro lens, you tend to overlook what's happening at the micro level. The households, the individuals, people like you and I. You cannot deny that the individual has been squeezed at both ends. Not only have we experienced 3 years of astronomically higher prices, but we were also hit with high interest rates, making financing extremely unaffordable and inaccessible. And what really, really sucks about this situation we're in is that it might only get tougher. There's two scenarios that could play out. The Fed could very well cut too early and inflation returns. And because inflation has returned, the Fed has to maintain an aggressive interest rate policy. That's keeping prices high and that's keeping financing still unaffordable. The Fed could very well cut too late, impacting the job market and causing unnecessary job loss and impacting asset prices, which will have a direct effect on 401ks, pensions, health savings plans, etc. But because interest rate policy is such a blunt tool, the outcomes are just so unpredictable. But anyways, let's keep this one short, y'all. This was my initial reaction to what's going on in the stock market, the job market, and the Fed's decision on interest rates. Do I think it's time to panic? Absolutely not. There's some data suggesting that recession isn't really a fear. There's some data suggesting that it is. My suggestion is to stay level-headed, to make the right financial decisions based on a long-term outlook. Enough of what I think, y'all, but what do you think? How do you interpret what's going on in the stock market? Do you think we're headed towards correction territory? Do you think we're headed towards bear territory? Do you think the job market will improve or do you think it'll worsen? And do you think the Feds have a good gauge of how their policy making has impacted you and I? As always, thanks for watching. Until next time, take care of yourself and best of luck.